Good afternoon, everyone, and welcome to this latest episode of the LifeTime Learning Series. My name is Jonathan Shepard. I'm one of the wealth consultants with LifeTime Asset Management here in the beautiful Suwanee, Georgia office, and I am joined today by fellow wealth consultant and the founder of LifeTime Asset Management, Mr. Guy Swain. Guy, thanks for joining us. How are you this afternoon?
Thank you, sir. Good to be with you.
Absolutely. Guy, I've been looking forward to tackling this particular topic for quite some time, the national debt and whether it is a cause for concern. And I think about the client conversations that I've had over the last several months, but I wanted to come to you for a very specific reason. My understanding is that in the last 4 to 6 weeks, you've had upwards of 80 plus client review sessions. And I'm curious from your perspective, is this something that our clients are concerned about, and is it coming up in your conversations?
No.
End of story.
Okay, is that the end of the webinar? Absolutely. This is by far the number one question that I've heard of late, going back even to the election and some of the concerns that we had. So certainly it's a major concern that comes up virtually every meeting.
Gotcha.
So,
well, I can certainly appreciate that. This particular topic, like I said, has come up quite a bit lately. And in the last year, I think about the topics that we have covered in this Lifetime Learning Series, and some of them are evergreen. Some of them are very procedural and process oriented, but we also want to be very responsive to covering those topics that are on our clients' minds. So in just 1 minute, I'm going to hand it back to you to introduce our guest speakers today. But for those of our friends in attendance, a couple things that I want you to be aware of. We thrive on your questions. We're actually going to budget time at the end of this webinar to answer direct questions from our audience. The easiest way to get those into our hands is to email us at info@lifetimeasset.com. That's simply info@lifetimeasset.com. We also want to make sure that you're aware that we are recording this webinar just like we've done every other session. And within the next 2 weeks, it'll be available on the Lifetime Asset website for either you to view again or to share with a friend, family member, or colleague. So with that being said, Guy, I'll hand it over to you to introduce our guest speakers.
well, thanks, Jonathan. And I know why they wanted us to be co-host of this event. I'm the oldest advisor, and you're the newest of our advisors. And you have a great radio voice, and I have a great radio face. So,
Match made in heaven.
So it works out great. Thanks to City National Rochdale, we have 2 of their professionals today. Marco Cementiglia, who is part of our team, along with Ted Cox and Elizabeth Dooley. And they have been the face for us for City National Rochdale for several years. City National Rochdale is a unique relationship. They are investment advisors, managers, if you would, financial managers of assets for large accounts. They tend to be $1 million plus, and they work with individuals and large foundations. So we have worked with them for the last couple of years, as I mentioned, and Marco and Ted and Elizabeth have been directly involved in that. So Marco, you're going to introduce our speaker, I understand, correct?
Yes, sir. And thank you for all that, Guy, and everyone who's joining us this afternoon. I'm part of your team here at City National Rochdale, working closely with Ted Cox and Elizabeth Dooley, as well as others at Lifetime for many years now. So this afternoon, I'd like to introduce our main speaker, Paul Single, who is one of my colleagues. Paul's a managing director and senior portfolio manager here at City National Rochdale. As an institutional bond manager for more than 30 years, he has developed an acute understanding of the economy and the Federal Reserve, both of which are needed for investment performance. Paul is also a member of the investment committee that determines asset allocation for our clients' investment portfolios, and also sits on the committee for the bank's management of assets and liabilities. Paul also writes most of the economic reports for City National, and he also has a monthly economic video that can be found on our website, www.cnr.com. And with that, Paul, I'll hand it over to you to take us through this presentation.
Marco, thank you so much. And thank you all for joining us today. It's really a treat for me to be able to talk to you all about this really important issue. Is the federal debt a concern? Well, yeah, it sort of is, but it isn't right now. I have a whole presentation here that I've put together to talk about the various parts of the federal debt. And I just want to take some time and let me just bring the presentation up, and hopefully we'll get started. How much debt is too much? Many people will say we might be there now. Many people would have said that 20 years ago. And the path we're on, it's going to get much worse. When you take a look at the federal debt, here's a chart here going back since 1900 to the present. And currently the federal debt is equal to almost $27 trillion. Let me put a little perspective on this. See this red circle here? That was the increased spending that we had for World War II. It was an awful lot of money then, but you can see it pales in comparison to the federal debt that we've had. And it's really grown quite a bit since 1980, which is an interesting phenomenon, and we'll get into that in just a moment. But there's this great quote from Everett Dirksen, he was a representative at first, but also a senator from Illinois, where he said, $1 billion here, $1 billion there, pretty soon you're talking about real money. That was a long time ago. Now the talk is trillion. And to put this in perspective, what does a trillion mean? Just put this together just to give some perspective, because if you use time, it tends to be something that people can relate to much easier. But 1 million seconds, 1/60th of a minute, how long is that? Well, it's about 12 days. If you have 1 billion seconds, well, that's about 32 years. So the difference between 1 million and 1 billion is the difference between a newborn baby and a fully mature adult. And of course, a trillion would be almost 32,000 years. And we're talking 27 trillion is what we have. It's a big amount. So that brings on an awful lot of fear that people have about what that means for the currency, because they're fearful that too much debt might be a problem in that it will devalue the currency. And there's plenty of history of that. There's the Weimar Republic in Germany about a century ago. There's Zimbabwe about a decade or two ago. And of course, Venezuela is the most recent one. And I have that because we can get some data on it. This is just their currency. And you can see how much their currency has changed. This is the amount of bolivars required to buy $1 US. A few years ago, it was 1 to 1. Now it requires 2 million bolivars to buy a US dollar. Keep in mind, this is the third time Venezuela's devalued their currency in the last couple of decades. They have a severe problem. I do like this chart. Bloomberg puts this together. It's what the cost of 1 cup of coffee is in Venezuela. And just to relate this to the United States, 3 years ago, if you were to buy a cup of coffee at Starbucks for $3, today, that would probably cost you around $9 million based on what they have there. Keep in mind, what is going on in Venezuela is not just large deficits that they have. They have a whole bunch of other fundamental problems with their economy, and that's why their currency is done so poorly. There are plenty of countries that have been borrowing money much more than the United States, most notably Japan, that doesn't have this sort of problem. But it is a bit of an issue that we have. This chart here is one that I really like because it just shows how we've how we've created the situation that we have. The dark blue line that you see is the year-over-year change in federal spending, the outlays that we have. And you can see how that's just skyrocketed through this recession. When you see economic charts that have gray columns, those represent recessionary periods. But you can see how it's gone up so much. But even long before that, it's been increasing. The light blue line is the amount of revenue coming into the federal government. And as you can see, that too has been increasing over time. But during this recession, it's only down a little bit. Keep in mind, an awful lot of the economy is still humming along and people are able to pay taxes. It's really the expenditure side. But look at the net difference between the two, that sort of blue-gray columns in the bottom right corner. You can see that the deficit that we have is about $3.5 trillion for the last 12 months. Now, you can see the numbers in the top left corner. Just look at this. I mean, the amount of revenue coming in is about $3.5 trillion. The amount of outlays is $7. The federal government is spending $2 for every dollar that's coming in. You and I can't get along with that, especially for a long period of time. But governments, they are capable of doing that to some extent until it becomes a bit of a problem. This chart here shows the deficit month by month for each calendar year that we've had since 2015. And the fiscal year starts in October, so that's where we're starting over on the left-hand side. And you can see last year in the green, the increased spending that started in March as the economy or the federal government has dealt with the pandemic. There was the large CARES Act that took place back then. Then eventually it played through, and we're starting to see it again this year with the dark blue line where the increased spending went on in January. So we're looking for a big deficit again this year. Now, you can't look at the deficit all by itself and compare it historically. You really need to compare it to the size of the economy. And, you know, it's just like trying to get a loan at a bank. You know, if you're worth $100,000, you probably borrow $10,000 without much problem. You can maybe even borrow $100,000 with a good story. But to borrow $1 million, that's pretty hard. But if you're worth $1 million, you know, you can probably borrow that with greater ease. The same thing is applying here. And one thing is great about data that comes from the government. Sometimes you can get long-term historical data. And this goes back to the 1800s. And you can see this is the amount of money that we borrow relative to the size of the economy. And there's a common theme that you can see here. It tends to be very high during wars or economic catastrophes. So the War of 1812, you can see how it shot up. And then we worked our way down. The Civil War caused it to move up. It worked its way down. World War I, it was high and started working its way down. But then the Depression came in, and then World War II came in. But from World War II, where it was at the highest it's ever been, to the early 1980s, it worked its way down from almost 120% down to about 35%. But since then, we've been increasing it without a war. You know, the way it works in Washington, and I'm not to be critical of our fine elected officials, but you know, as long as we elect people that want to cut taxes and increase spending, we're going to get larger and larger deficits. So even during the times where the economy has done very, very well, especially 2010 to 2020, we continued to grow the deficit. It's just what has been happening. That's the way it is. So the pandemic, that's the most recent situation. Now, to look at the same sort of information on a shorter period of time, you can also see some important themes. This is showing the receipts and outlays relative to GDP. So the outlays, which is in the dark blue, and the receipts or revenue coming in is in the light blue. And you can see we've had a differential between those. That's pretty average. It did get a little different in the early 2000s. Remember back then, that's when tax revenues outpaced the amount of spending. But a lot of that had to do with the fact that that was the dot-com rally. The capital gains tax added an awful lot. But if you look at the dotted lines during this period of time, you can see a pretty consistent theme, and that is that on average, we spend more than 3% more in revenue than we bring in relative to the size of the government. And you know, that's just not a sustainable path that we can continue to have. But again, continue to elect people that want to cut taxes and want to increase spending. That's the situation we're going to have until that changes. So what's it costing us? Well, in terms of dollar terms, a lot. You know, this chart on the left shows the amount of interest on Treasury securities. The data is only available through 2019, but you can see what the trend is. It's been increasing over time as we've accumulated more and more debt. It's just costing us more and more money. You know, and at $575 billion per year, that could be spent on other things. It can't. It's being spent on servicing the debt. But again, you need to relate it to the size of the economy. And this is where it gets interesting. This is a chart here that has that data, the amount of money that we spend on interest payments relative to the size of the economy. And you can see during the 80s and 90s, that really skyrocketed quite a bit. The government was borrowing an awful lot of money relative to the size of the economy. Interest rates were a whole lot higher, and as a result, the cost was extremely high. The dotted line across the middle there just shows what the average was for that period. But what I have in here is what's expected, and this is an interesting phenomenon that's going on. The CBO, the Congressional Budget Offices, which is a nonpartisan group that does great work in terms of working on the deficit. You can see in the blue line there, their expectations back in January of 2020. And you can see where they expected it to start to increase quite a bit. Fast forward to September of last year, after the Fed had lowered interest rates, had entered into all their quantitative easings and pushed down longer term interest rates, you can see on a relative basis, relative to GDP, that the cost actually was declining and then would eventually work its way up. So we're seeing the relative cost not to be as high as what one would assume, despite all the debt that's being issued. Now, there are natural buyers of Treasury debt, so that's a nice thing that's going on. You can see here on the left-hand side, Social Security, they buy an awful lot of debt because for years, they would bring in more revenue than what it would cost them in terms of payments that they had to send out. So they've been buying, they have a portfolio of around $3 trillion worth of Treasury debt. The thing is, if you notice in this chart, the last few columns are all around the same area. Social Security Administration is getting to the point now that they're actually spending more than they're bringing in. So they won't be as bigger buyers as the Treasury debt. And that's because the baby boomers are retiring and the amount of revenue coming in is not enough to offset the payments have to be made out to that large economic group. Another big group of buyers of treasuries is foreign central banks. They have to own treasuries to transact business, to make money flow back and forth. So a combination of these two, you're talking around $6 trillion in debt will be bought by these two entities. So that helps keep longer term interest rates low because of these natural buyers. Another one that's become a big buyer of Treasury debt is the Federal Reserve Bank. And this is a move that really started during the global financial crisis of a little over a decade ago. You can see, again, before that recession, right above the 2009, the amount of Treasury debt that the Fed would own was a little bit under $1 trillion. It was around $800 billion. But one of the ideas that Bernanke came up with as head of the Fed at the time is that maybe the Fed should be leveraging up their balance sheet because their whole economy was deleveraging. Let's offset that and try and get economic growth back. The Fed can lever up their balance sheet. They can buy longer term securities. That does a couple of things. Most importantly is that it buys up the supply, and the amount was relatively limited at that point, and that pushed prices up, which pushed interest rates down. That meant other interest rates were able to come down. It really benefited the economy because they were able to expand quite a bit because mortgage loans came down, people were able to refinance, have more disposable income. Auto loans came down quite a bit, and that really helped out confidence quite a bit, and that helped get us out of the recovery. And you can see as we went into 2011, they continued to buy securities. In 2012 and 13, when the banks were having an awful lot of problems, they continued to buy more and more securities, and they got up over $2 trillion by 2015. But at that point, the economy was strong enough to walk on its own. You know, it didn't need the crutches. So they stopped buying securities. And then around 2018 and 19, they started to decrease the amount that they were buying, and you can see that it came down. But look, during this recession, they really increased the amount of buying that they did. Much more at a much faster pace. They bought more in a shorter period of time than they did in the previous time around. That's what's helped us get out of the recession very, very quickly. But again, now they're big owners of Treasury. So a combination of the page before was $6 trillion plus this $4 or $5 trillion. There's natural buyers of more than $11 trillion of the debt. And again, that's what's helping to keep interest rates low. In terms of the expectations going forward, well, the CBO is expecting an awful lot. The baseline projections of debt, you can see on the left-hand side, is continuing to grow. And as a percent of GDP, they expect it to continue to grow. And this chart, it's a lot like the one we had before. I just instead of showing it all the way from the 1800s, just to be able to focus on the future, I cut it off at 1900s. But you can see the expectation for debt to GDP is going to get up to around 200% of GDP. So we'll be borrowing twice the size of this economy in 30 years, which is a pretty short period of time. Now, when does it become a concern? Well, it becomes a concern when it's a concern. This is the hard part of it. It's not an easy question. Right now, the United States isn't the only one that's doing this, keep in mind. The whole world, by and large, has been increasing the amount of debt that they have. But the United States is the largest economy in the world. It's about 25% of the world's economy. So it becomes an important issue. Economists in the past have talked about this an awful lot. And the general rule of thumb is that when you get above 100% of GDP, then the cost of servicing the debt becomes a burden, and it starts to squeeze out other programs, most notably social programs. And that tends to get the public upset because they rely on that, or they think that certain people should be relying on it. That's roughly where we are. We are at 100% of GDP, and so we're in that area. But keep in mind, interest rates are low, not squeezing out debt. Population is getting older; they buy more debt than they used to. We're not at that point yet, but at some point it will become a political liability for those in Washington. Now, as I mentioned, we're not the only ones that have an awful lot of debt. This is old data. This is the hard part, is to try and find one source for calculating it. Because when you look at like the United States debt, you got the Treasury calculating it, you got the CBO calculating it, you even have the CIA calculating it. That's where a lot of some of this data comes from. But to find a consistent source, this is 2018 data. You can see other countries have much more debt than we do. Japan and Italy. Japan, not a surprise, they were in a recession for more than a decade, but they self-finance. They don't rely on global investors as much. Goes into an awful lot of the government pension plans. So it's not as crucial to them, but you can see the numbers are quite high. Whereas other countries, that have an economy so an awful lot like ours, like UK, France, Germany, and Canada, they have much lower levels of debt to GDP. I want to talk about modern monetary theory. This is a bit of a controversial and unorthodox view of macroeconomic policy. It's been around for about 100 years, MMT has been. It became popular 6-7 years ago when Bernie Sanders was running for president in 2016. And it's really grown in publications quite a bit, because the Green New Deal looks at this as a way of funding that for the progressives. And it's the belief that a country can actually borrow as much money as it wants until it becomes an inflationary problem. But there are some requirements of it. To borrow as much as you want, it has to be in your own currency, and your currency has to be free floating. And the belief is that you can borrow as much as you want until it becomes a problem for inflation. And when it does become a problem for inflation, that's really the central bank's problem. It's their job to rein in the economy, but maybe by increasing interest rates, which would then help out the currency a bit. But it seems to be catching on in Washington. And a lot of people think that's where we are right now, especially with the Fed's buying. That's not where we are. The Fed is very clear on this. They have said they're going to stop buying Treasury securities. And they're buying a lot, keep in mind. They're buying $80 billion each month in Treasury securities. But they said that they will stop doing that as soon as the economy gets better. So they're using a Keynesian approach to just try and help out the economy. But the MMT If you look at the deficit, you might think those in Washington, despite them criticizing the debt, they always have to find ways to spend more year in and year out. So those are the issues that are surrounding the debt. And just before I open it up to some questions here, I just want to say is again, the debt that we have is large. It's much larger than what we've ever had, except with the exception of World War II. The reason why we were able to bring it down from about 120% of GDP in World War II down to about 35% in the early 80s was a number of economic events that were going on that helped out quite a bit. Keep in mind, in the late 40s, 50s, 60s, and into the 70s, we were the manufacturer of the world. A lot of people wanted to invest in the United States. The economy was growing really, really fast. So the amount of debt, because we still ran deficits every year, but the amount of debt relative to GDP fell because the economy grew at such a faster and faster pace. Now we're at that same sort of situation where we have a high level of debt to GDP, but the outlook is a lot different. We are not the manufacturer of the world, so that will restrict some of our economic growth over the long term. The population is not growing quickly like it did following World War II, so that's another factor. And so that will have a big impact on the future. But the biggest impact that we have on the future is the fact that the liability side of the federal government's balance sheet is going to look a lot worse because we're all getting older. Baby boomers are retiring. The cost of Social Security, Medicare, Medicaid are growing much faster than inflation. And as a result, that's why the CBO has that expectation that debt to GDP will stay high for some time. So to answer the question at the beginning, is it a problem? Not immediately, it's not a problem, but over the next 5 or 10 years, we do need to do something to start to correct the problem of the growing deficit before it does become a problem. Why don't I open it up to questions now?
Great, Paul. Thank you very much for that information. Just tremendously beneficial to us all. It's interesting. A few of the points that you shared with us around it cost $2. We basically spend $2 for every $1 of revenue that we bring in. It's just an amazing stat. And as I look at some of the questions that have come in, we talked a little bit about some of the owners of this national debt, and you referenced the Social Security Administration. You also referenced the Federal Reserve Bank. But when it comes to individual countries that own portions of this debt, who are the highest or the top individual country holders?
Well, the U.S. is the biggest because of the Federal Reserve Bank with their large balance sheet that they levered up. I believe China is 2. The UK is pretty high, but that has an awful lot to do with taxes and hedge funds and so forth. It's not that they're big investors. There's the investor groups that are based there.
Gotcha.
Japan is also a big investor in the United States too.
In looking at some of these foreign governments that own a very large portion of our national debt, should we be worried about a foreign government demanding repayment short term of that debt?
Well, the biggest issue is with China because they're such large owners. But keep in mind, if that happens, then we would make those payments, and those would get converted to their currency, which would increase the value of their currency, decrease the value of our currency, and then make trade not nearly as attractive, or exporting not nearly as attractive for them. That's a big part of their economy. The U.S. and China has this dysfunctional relationship that relies heavily on each other. They rely heavily on our spending overseas and running our large trade deficits, and we rely on them to finance our treasury debt. Not the best of worlds because it makes negotiations very, very difficult. It's very hard for us to sit and try and justify, intellectual property laws with them or human rights rules with them and laws when they own an awful lot of our debt.
Certainly. We had another question come into the inbox, and it is, how will U.S. debt impact the stock market and the private sector?
Well, if the government's running large deficits, it's growing the economy faster. They're leveraging their portfolio. So that's been a big part of helping out the economy in terms of growth. So the stock market has rallied on that. When they start to cut back on the amount of debt, that will be the impact that we have. And can they do it in a tactical way so that it doesn't impair the economy or it doesn't have that big of an impact? But right now, it's a big crutch for this economy. They are borrowing an awful lot of money to keep this economy going. And no one's complaining about that, even the hard-nosed deficit hawks, because the analogy that I read several times about this is it's like a farmer whose barn is on fire. They need to use as much water as they can to put the fire out. They shouldn't stop and worry about how much their water bill is going to be. Get the fire out. And that's really what we have right now. We have a devastating economic downturn. I mean, we've got 9.5 million people without jobs compared to this time last year. That's a lot, even though we've had a great recovery. I mean, 9.5 million is bigger than what we had in the global financial crisis of a decade ago. So it's being well used at this stage, but again, you do need to get a long-term plan to try and reduce that.
Certainly.
Before it becomes a critical problem.
One of the other questions that came in was, with interest rates so low, isn't it a good time for us to borrow to finance new investments? Biden just unveiled a large infrastructure plan. So what are the benefits of us taking on additional debt at this moment in time?
To me, that's a great question. It's optimally, it's a great time to do that because the cost of financing the debt is below inflation. So here you can make all these improvements that will help increase productivity, which will lead to stronger and stronger economy. It's very beneficial. Larry Summers is a big fan of that aspect of it. But the thing is that we're doing it at a time when we already have big deficits. And the deficits, as I mentioned earlier, they've been growing since the 80s, for even during strong economic times to grow the deficit. So normally those are times where you should have cut back, but that's history. You can't change it.
Yeah.
But this, the infrastructure bill, and then the next stage that he's planning to announce in April, you're talking around $3 to $4 trillion that the Biden administration is looking at. But that will be spent over the next 2 to 10 years. It's not immediate like the last few stimulus plans, starting with the CARES Act that got people $1,200 and $600 and $1,400. These are stimulus plans that are structured for the long-term growth of the economy.
Gotcha. One of the last two questions that came in was, can we really have a fiscal crisis if the U.S. is borrowing in its own currency?
Yeah, I mean, that's part of what MMT is all about, is that no, we don't, but until it becomes a burden. And, it's at some point, when you get the crowding out effect or when interest rates start increasing, if you start to see the dollar fall in value and interest rates start moving up and there's not as many foreign buyers, that's what you're trying to avoid. Mm-hmm. And not have to make hard changes in the deficit at that point. So that would cause an economic slowdown by itself. And then if you start to reduce the size of the deficit, it would exaggerate it to a higher degree. But yeah, as long as you can borrow in your own currency and it's freely traded, then probably not a problem.
Gotcha.
Paul, I've got a question for you, please.
Yes.
If the economy slows and interest rates move up, that's our worst nightmare as far as our debt is concerned. Now, since you've been talking, I've had the national debt clock running. So I am not going to share how much it's gone up over this brief period of time. But as you know, it's somewhat astronomical how quickly we're adding to our debt. Now, I know we're not Japan, and we have immigration, we have growth, we have birth rates that are far more advantageous than Japan. But at some point in time, we're going to have another recession, and the cost of the debt eventually has to be higher, doesn't it? And what kind of impact will that have?
Yes, some point, and I mean, the economy is rip roaring this year. The Fed's expecting growth to be 6.5%. We haven't seen that growth since the early 80s when Reagan ran up deficits. So we will see strong growth this year. That will mean that the Fed will be able to eventually stop buying as much debt as they were, which means upward pressure on interest rates. We'll see a little higher inflation, not a whole lot higher, not enough that the Fed's going to get overly concerned with it, but we'll see that also. All of those will push up interest rates. I mean, it's just part of the cycle that we'll be going through. And that's where it becomes an issue. Can they keep the economy going strong enough to afford the higher level of cost of running the economy, which is cost of interest rates, which is, you see in the leverage, before the next recession sets in. And hopefully, I mean, one of the big things that does work to our advantage is if you look over time, the length of recessions tends to get shorter and shorter, and the length of expansions tend to get longer and longer. I mean, the one we just ended was a record long. It was more than 10 years. So it's that crossroads. How far can you put that out, and how much of a relatively acute angle they offset each other in terms of the cost of running the economy versus the pace of the economy. And time will tell on that one.
Very good. Guy, any other questions?
No, I think your comments about consumers, all of us tend to conflate the national debt and the stock market and economic activity, sort of lump it all together. But just look at Japan over the last 20 years, there have been select stocks there that have done incredibly well. So the fact that our debt is increasing doesn't mean our stock market is going to decline in value. And I think they're separate issues, and not that they're not correlated to a certain extent, but I think sometimes we take one aspect of the markets and the economy, and we tend to imprint that on the rest of it. So this has been, in my view, very, very helpful for our clients. Thank you so much, Paul.
Oh, my pleasure. Just to add on, just because people love to compare with Japan, keep in mind Japan's a very different economy than ours. It's far more closed than ours is. Their working population is actually declining. Ours is increasing. If you want to grow an economy, you need to increase the size of the population. That's the fastest way to do that. Their banking system is much different than ours. They have to hold on to bad loans for a long period of time, so they can't lend out as much. Whereas in the United States, we tend to sell off bad loans and get some capital to start lending again. It's a much different scenario. So the fact that we have large debt doesn't mean we're going to have the same scenario that Japan had.
They don't have enough babies.
I'm sorry?
They don't have enough babies.
Right, and they don't allow, we don't allow many immigrants. They allow a whole lot less. Women aren't in the workforce nearly as strongly as the United States is.
Yeah.
Very good.
Stuff.
Well, Paul, we certainly want to thank you and share our appreciation to both you and Marco and our friends at City National Rochdale. Just a tremendous amount of information shared, a lot of valuable information shared. And I think one of the main takeaways that we can take into our client conversations is, we have to keep an eye on the national debt. It's something that is certainly on the radar, but we do not want it to interfere with solid investment policy in a goal-oriented financial plan, which all of our clients have. So keeping an eye on the long term for sure. And I loved your saying, I think you said it's a problem when it's a problem. And we're certainly keeping our eyes out for that. But seriously, thank you both for joining us today. And we certainly appreciate the work you do on behalf of the families that we serve.
Thank you. It's a real treat for us to be here. We really appreciate it.
Absolutely. For those of you in attendance, just a couple quick items to discuss before we part ways for the day. We have certainly enjoyed presenting these Lifetime Learning Series webinars. And just a reminder, they happen on the first and third Thursdays of every month. The next webinar that we have scheduled is actually for Thursday, April the 15th. And our very own Director of Financial Planning, Leslie Gaddis, is going to be taking us through a conversation on the student loan forgiveness program. So if you yourself have a child that is in the student loan program, or friends and family, please don't miss that. Definitely tune into that. And if you have any residual questions from today's webinar, don't hesitate to get them to us at info@lifetimeasset.com. With that being said, on behalf of all of us here at LifeTime, we thank you. We appreciate the opportunity to serve, and we look forward to seeing you soon. Thanks so much.